Good morning, everyone, and welcome to today's webinar focusing on the current challenges faced by the charity sector and how charities can minimise the economic impact of COVID-19. Before we get underway, just some housekeeping announcements. Everyone has been centrally muted in terms of distractions. All our presenters are home working, so I apologise for any background interruptions or distractions or technical glitches, and should any issues occur, I'm sure you'll all bear with us. The slide deck you will be seeing this morning will be made available later to delegates, and we are also recording the event, and a link will also be made available. Please also visit our Coronavirus Hub for recordings of our other webinars. Next slide, please. We do want your questions for this session, so please use the Q&A function, and you can see on the screen as to where to go. I'll endeavour to ask the panel as many of your questions as time allows, and we will be concluding today at 10 a.m. sharp. We would very much appreciate your feedback after the event, and a link to our survey will also be provided in the chat function for you to complete. Next slide, please. In terms of your presentation team today, I am Diana Franke, your host, and I am a Restructuring Advisory Partner here at RSM. And I'm delighted to introduce Ian Burrows, a Charity Investment Manager at Brewin Dolphin, and Deborah Burton, a Legal Director in the Contentious Trust and Probate team at Shakespeare Martineau. We're in no doubt that this is an ever-changing environment for the charity sector, as it must reimagine and readapt. And this is in terms of IT and digital transformation, cash flow and reorganisation of the structure, fundraising and resilience for industry-specific parts of the sector, like animals, arts and culture, care, and membership organisations. And as an example, there's been a genuine concern that the restrictions over the summer wouldn't generate enough money for zoos to survive the winter months. And as you'll appreciate, zoos weren't able to furlough as many staff given the need to continue to look after the animals. However, we are pleased to see positive signs from visitor numbers, which will mitigate existing and further expected costs during the winter to follow. The sector has experienced a lack of fundraising due to the loss of usual external events restricting its income. We've seen a push for financial modelling and the need to look at new income streams and focus on cash flow management. And there's been a need to move towards digital working, resulting in a changing business infrastructure to save on office space and focus on a hub of or a smaller office footprint. However, there's also a greater need for cyber resilience and fraud awareness due to the lack of IT infrastructure and to current working practices. With the high volume of grant applications, there's an increasing competition for these funds, and therefore driving a greater reliance on investment and legacy income, and the need to manage cash and mitigate risk is therefore critical. So without further ado, I will now hand over to Ian to discuss in greater detail the impact of COVID-19 on investment income.
Thank you very much, Diana. So my name is Ian Burrows, and I head the Specialist Charity Investment Management team for Brewin Dolphin for the Midlands. We've got 8 specialist teams around the UK. I know there's a number of guests on from all corners of the country today, so I'm sure we'll have a team close to you. We've given ourselves only kind of 10 minutes each. We wanted to keep this webinar quite short and snappy, so I'm going to whiz through the 2 things I'm going to talk about. And they really focus on 2 main areas. I don't really want to dwell too much on where the economy is at present. I think that's probably well understood. The more important thing is where will the economy go from here? Hopefully that will be relevant to all charities in terms of where their funding comes from, but also perhaps in terms of what their beneficiaries are doing and how they can help them. The second area I want to talk about is really only for those charities that have investments, and I appreciate that's not all charities, they're not all fortunate to be in that position, but I want to delve into the details as to how might your investment income be affected, what can you do from here, and what options do you have on the table. And when talking about the future, I am, particularly in this environment, reminded of the famous quote, which I think was from a physician who said, "Prediction is very difficult, especially about the future." And I think that's relevant because I don't have any better idea than anyone else about exactly when we might find a vaccine or when or how severe any second wave to the virus might come. So please do bear that in mind. But when we do start talking to commentators, analysts and the like about what the economic recovery might look like, Many ascribe a letter from the alphabet to try and represent the type of recovery that they foresee. And I've put some of the main ones on the screen here. The V-shaped recovery is perhaps our preference. That will see the economy bounce back to its previous size pretty quickly and pretty directly. The U-shaped recovery sees a bit of a fallow period before any eventual recovery, so we might go through some fallow months. A W-shaped recovery is perhaps more akin to a double dip, perhaps with that second wave. And the L-shaped one is obviously to be avoided and doesn't really see much by the way of recovery at all. So what do professionals think? What are the analysts saying? This chart is taken from a survey that Bank of America do every month. They survey fund managers all around the world and ask them different questions. And we can see here, I guess there's two key conclusions that I would draw. Firstly is that there's quite a wide divergence of views. There is no consensus behind any particular form for the recovery. And the second conclusion that I would draw is that the preferred V-shaped recovery seems to be the least likely, and it also appears that the probability that we will have a V-shaped recovery has decreased, given that fewer fund managers have selected that option in the July survey compared against the June survey. But what's the data telling us? These charts are taken from the Financial Times, which are updated on pretty much a daily basis, so they give us almost live data, and they cover some of the most important areas of the economy, or some of the ones that we can measure easiest. And what they're generally telling us is that the economic recovery has started, but it has started at perhaps a fairly shallow pace so far. We can also see that the recovery in the UK has been slower than some of our European peers, but we are starting to move in the right direction. And depending on which aspect of the economy you measure and which particular day, it seems that we are somewhere between 40 to 50% behind perhaps normal conditions. But we are starting to move ahead, and as lockdown conditions ease, it does appear that the economic recovery is in play. So we've touched on all of those different letters, but what's our view at Brewin Dolphin? We don't think actually that you can ascribe any single letter in the alphabet to describe the shape of the recovery. I'm not sure that there's one that exists. I think if we were forced to try and describe it, I would say it would be more like a reverse square root sign, perhaps with a corrugated tail. Now that sounds very, very complex, so let's just break that down. In simple terms, there's probably two stages to the recovery. The first stage will look very much like a V-shaped recovery, and that is simply because people are now starting to get back to work, starting to go back out to the shops. There's an awful lot of pent-up demand that is now starting to be spent. And certainly around me, there's an awful lot of builders' vans and skips on drives. And with the government stimulus as well, there was an awful lot of immediate rebound. However, as we progress through the year, particularly as the furlough scheme starts to ease towards August, September, October time, we believe that shape of that recovery will start to flatten and will pivot towards a bit of a slower scale of recovery, particularly as there is likely to be some form of economic scarring from the crisis that we've been through. There are companies that haven't made it and won't make it out. Unfortunately, there are jobs that will have been lost, and therefore growth will slow down a little bit in the second stage. The chart I'm showing on the screen is taken from the OBR, the Office of Budget Responsibility, and that is pretty much akin to what we're expecting to turn out. And I guess the key thing from this chart is that they don't expect the economy to regain its present or its prior level, i.e. its pre-crisis level, until the end of 2022. I think we'd be slightly more optimistic in that respect, but hopefully that will give you some broad idea. You'll see there's two dotted bands around their central forecast, and that really illustrates the range of probabilities that could happen depending on when a vaccine comes or how any particular second wave pans out, and really just highlights the uncertainty that could occur in the economy going forwards. But I think the central point here is that we will recover, the economy will get back to normal in time, and there's no need to necessarily be overly pessimistic. So let's move on to looking at investment income, particularly for those charities that do have investment portfolios. A traditional portfolio or a typical portfolio really tends to get its income from three primary sources. Fixed interest is your government gilts, your corporate bonds, and these pay interest. Here, income is likely to be affected, primarily because interest rates have fallen from 0.5% to 0.1%, i.e. they're at a fifth of previous levels. However, the impact might be mitigated by the fact that you perhaps have relatively less in these areas than other areas of your portfolio, and also as the overall level of income was fairly modest to begin with. On the far right-hand side, property has traditionally been a very good income-yielding asset. However, as we can always see in all of the news headlines, there's an awful lot of occupiers of businesses that lease property who are struggling. And a lot of property companies or property funds that we talk to have reported receiving rental income of only somewhere between 1/3 to 80% of normal levels during the crisis period. So clearly, for this period, there are going to be property funds who are reducing the amount of rental income they can pay out to their investors. And I guess the portion in the middle, equities, our stocks and shares, is perhaps been the biggest hit. Now, this headline, which I took from the FT recently, is quite shocking in terms of the fact that dividends could be down by 57%. Now, that only relates to the second quarter of this year, i.e. from April through to June, not for the full year. And I've tried to show below where that is coming from, the type of companies that are cutting or suspending their dividends. And for me, they fall into four main areas. There is the directly affected companies in the top left here, the likes of British Airways owner International Airlines Group, Intercontinental Hotels, who own the Crown Plaza and Holiday Inn brands, etc., where we can fully expect they have suffered during the lockdown from being unable to operate, and I don't think it's unreasonable for them to cut their dividends. Below we see the banks, where one could argue that perhaps they were financially strong enough to carry on paying their dividends, but where actually the regulators have forced them to suspend them during this crisis period to ensure that they have sufficient capital. The top right-hand box is perhaps the most interesting. These are companies that are perhaps less affected or less directly affected, but have also still chosen to cut or suspend their dividends. They include the likes of Sainsbury's, which one might have assumed could be a beneficiary. Imperial Brands is a tobacco company. And I think there are two things going on here. One is that any company that is receiving any form of government stimulus or government subsidy has been reluctant to pass on that money back to shareholders. So Sainsbury's is the beneficiary of the rate cut. Others have taken advantage of the fact that many other companies in the market have been cutting their dividends and have kind of seen this as cover to be able to cut their own, and potentially those could be longer term impacts. And the bottom right is perhaps one of the most surprising, or certainly to us. Royal Dutch Shell had previously had an undisturbed dividend record since the Second World War, but they took the opportunity following the oil price drop at this time to rebase their dividend, and that will certainly be a lower one going forwards. So when we look across this group, we can certainly tell that there are a number that will bounce back in terms of their dividends in the future. But I would add a note of caution, and that's really to do with this chart here. The chart measures the amount of dividend payout, which is the amount of profits that companies pay out to their shareholders each year. The chart that actually UK companies have been paying out a far higher proportion of their profits to shareholders than many of their international peers. Well, that's important because it means that there is less room for any drop of profits to be incurred by the company before it feeds through into dividend payouts. And it also suggests that there is less capital spare to reinvest for future growth. So I believe it might be likely that some companies will take this as an opportunity to rebase their dividends and without necessarily bouncing back straight away to start from a lower level. So with that in mind, what can you do about it? The one key thing is an area that Brewin Dolphin has been doing for many years actually, is that rather than focusing just on the UK, which is the area that I've been talking about, to actually expand your search and to look internationally. Many overseas stock markets typically offer lower starting yields than the UK, but as you can see from this chart, have been less affected by the current crisis in terms of their dividends. We can certainly see when we look at the US, for example, which is the largest stock market in the world, there's been relatively few dividend cuts, and actually the cuts that they have been outweighed by the amount of companies who've been able to increase their dividends. So diversifying internationally, although it might provide you with a slightly lower yield to start with, could help to provide you with much greater dividend sustainability. The second area to look at is in regards to alternative assets. So if we don't think that property is going to provide us with that yield in the near term, and certainly it's got its challenges longer term, then other forms of alternatives might also be worthy of consideration. Infrastructure is a key one here, which we've certainly seen through this crisis has continued to pay a resilient and strong income yield with capital values that have certainly done the job for investors too. And the third area, if income is critically important to you as a charity, then you might like to consider adopting a total return approach, which is one where you can also withdraw capital alongside income to supplement that. Now, total return is probably a big enough subject to deserve its own seminar, so I won't dwell on it too much here, but I'm very happy to take questions either in the Q&A, as Diana has described, or by contacting me directly. But overall, in summary, I would suggest that the two main points I wanted to get across: the economy will recover. We'll see an initial burst, we expect now, but actually the broader term will slow down a little bit. Investment income will be hit in the very near term, but longer term, I still think that investments are a very good way for charities to diversify their income streams. And again, that will come back in time. I've had to include my risk warning here. I'm normally quite flippant when I talk about that, but as this is recorded and as my compliance colleagues might be listening in, there it is. I'm sure you're all speed readers, so I won't dwell too much on that. And instead, I will pass you straight back over to Diana.
Thanks, Ian. Next slide, please, Ian. So during this session, I propose to provide an overview of the release and the support that are available to charities, and consider the importance of decisive and timely decision making, and just look at cash management and how to manage risk under these challenging situations. What I'll also do is I'll provide an overview of some of the restructuring options available in the event the charity is in financial distress, and look at the important considerations for trustees if a charity does become insolvent. Next slide, please. There are various specific funds that are available for the sector, some being general funds, and some are actually for arts, heritage, and other specific areas. And it's worth looking at the Charity Bank's website here, where there's a link to all the emergency funding that's available. We'll have seen a lot of press, particularly around the government-backed loans, around the C-bills, as we call it, and the bounce-back scheme. And the sector has also launched its equivalent, being the Resilience and Recovery Loan Fund, which offers emergency loan funding between £100,000 and £1.5 million. But it's important, obviously, to note that these are loans and they do need to be repaid, albeit that the first 12 months are actually interest-free. So consequently, before any charity considers any borrowing, it should check its constitution and that it can borrow, and of course ensure that the charity is in a position to make the repayments as and when they fall due in the future. Next slide. So by far the furlough scheme, I think, has provided the most positive impact, enabling businesses to manage the cost of their workforce as their income has substantially declined. Now, flexible furloughing was introduced from the 1st of July, where employees are given that flexibility to bring furloughed employees back to work part-time and remain under the furlough scheme. And individual charities will need to decide here what hours and patterns employees can work, and will be responsible for paying the wages for those hours. Now, where possible, staff can be redeployed to other roles to help meet the needs of the charity and its beneficiaries. But it's important, however, to note that if employees are furloughed, they cannot work or volunteer for the charity, even with the flexible furloughing. And the government contributions towards this scheme are starting to reduce until the scheme closes. So that's currently planned for the end of October. So the scheme will reduce from 80% to 70% in September and 60% in October. Now, the VAT deferral period has now expired, and the outstanding liability for this period must be repaid by the 31st of March next year. Next slide, please. So what does an organisation need to do if it finds itself in financial difficulties and is seeking to obtain funding from some of the sources we have identified? Well, firstly, identify the problem. Principally, it's going to be the decision around ongoing trading, and consider what's necessary for support both operationally and financially. It's important that you minute your decisions and the decision-making process itself, and the production of short and medium-term forecasts under a range of scenarios is imperative. So typically, we recommend a rolling 13-week cash flow forecast, which is updated weekly, as this pretty much captures every payment within a trading cycle. And that can identify any funding gaps where they're not able to be met from the existing funds and provide that opportunity to plan what is intended for that gap to be funded. But it's important to be as realistic as possible when preparing those forecasts, even to the extent of being overly prudent to provide as much visibility as you can on any funding requirements, because funders do need to know that the management teams have an achievable and realistic forecast. And once that funding gap has been identified, the key really is to establish whether the organisation can generate sufficient cash to repay any proposed new borrowings. And this may lead you to a decision, as you see on the right of this slide, in terms of whether a restructuring or a turnaround plan is required. And that could involve a merger, a joint venture, use of shared services within like-minded providers, new funding or a combination of these, or indeed whether you're actually faced with a difficult decision of closure, and whether that be on a solvent or insolvent basis. Next slide, please. Of course, the priority here is to manage your cash sufficiently that you don't require that additional borrowing and the organisation can survive a prolonged period of reduced trading and government restrictions. But to do this, you'll need a cash flow model, and whilst it's as difficult to produce at the moment in these ever-changing circumstances, it is critical for decision-making purposes. And you'll have no doubt already had to make that assessment on which payments are critical. And by critical, we mean simply that they will stop the business or cause significant long-term damage. And seek to delay or defer what you can. Assess who is key and understand what you can pay and when. But negotiate. Don't be afraid to ask for longer or to pay less. And plan those key messages and explain the situation and stick to that commitment. And clearly, let's not forget, if you are owed money by customers, establish whether some of your customers are still getting paid. And if so, then ensure that you are being paid in return. And constantly review those decisions throughout the process. Because circumstances are changing constantly. And here I do mention reserves as they're normally retained for emergencies, and if unrestricted, there are funds that your organisation has which can be freely spent on any of its charitable purposes. But normally you would keep a certain level of reserves. However, these are unprecedented times and you do need to consider what's best for your charity in conjunction with your reserves policy. Of course, you'll need to establish if there are restricted or unrestricted reserves, as restricted reserves cannot be used without the funds or charity commission approval. But look at your designated funds. Consider whether you'll be continuing with these projects now, such as, for example, a building of a new centre, or are these funds now free to use? And make sure you do engage with your funders. Ensure that you can provide them with those short and medium-term forecasts, identifying that funding shortfall. And they'll want to know your needs and have the confidence there is a clear plan of action. And just don't avoid those difficult conversations. Communication does remain key in this process. Next slide. So here it's about creating a plan, and this is based on the best information you have available at that point in time. You know, we know the plan will change, but it will just help to retain focus and include some milestones for anticipated decisions throughout that forecast period. And as trustees and directors, you should be challenging the assumptions upon which the projections are prepared. When preparing those plans, plan for the execution date and work backwards. This way you can identify those pressure points. Then stress test that plan so that you understand the impact if there is a divergence from the projections. And ensure you have like KPIs identified, so if they are missed, the board can adopt a contingency plan and take steps to minimise the losses. Financial accounts should be provided at least monthly to the board and compared to budget, highlighting those KPIs and variances. And trustees should be meeting regularly, minute their meetings and ensure that the minutes are retained. And if you are concerned about trading on, do seek professional advice. And, I can't keep stressing this enough. Engaging with funders is important. Continue to liaise with them and provide those accounts. And just keep looking out to seek to apply for those grants and seek approval where required to use restricted funds for other costs. And it's really important here to undertake a risk assessment to understand the impact in the event that a part of your organisation may fail or a service line falls away. What does that look like, and what would you need to do? Next slide. So there are two key tests here of insolvency that trustees need to be aware of. The first is a simple balance sheet test. So do the liabilities exceed its assets? And you may need to factor in contingent liabilities into that equation and consider whether the likelihood of that liability, is going to be triggered. But that test in itself is not necessarily evidence that the business is insolvent. The key test we look at is whether a business can pay its debts as and when they fall due, and this is known as the cash flow test. So potentially the solvency of your charity could be reliant upon your ability to negotiate new terms with suppliers and funders. And I think one point really to be mindful of is that UK legislation deems a business to be insolvent if a statutory demand is served on it and payment of that demand is not made within a statutory time allowed. That's usually about 21 days. If that occurs, then you do need to be very careful of your actions as trustees from that point forward. Now, at the moment, under the temporary insolvency provisions, a company cannot issue a statutory demand up to the 30th of September. So moving on, let's look at, if a charity believes that it could become insolvent. Next slide. So here, officers really need to consider their fiduciary duties in conjunction with the best interests of the creditors to ensure that the position of the creditors does not deteriorate any further. Any actions that are being taken must maximise the recovery from the winding up of the organisation. And organisations will also have responsibilities to their staff to ensure that their entitlements are protected as far as possible, and immediate steps must be taken to protect the position, including seeking that professional advice where a formal insolvency process may be necessary. And again, it's to reiterate that timely decision making is required here, and that there's a need to document decisions and the advice taken in order that you can mitigate the loss to creditors and protect the position of the beneficiaries. And if not, then the trustees expose themselves to personal liability for the deterioration in the potential recovery for creditors. Next slide. So where the charity is an incorporated organisation, there are several options available, and this will depend upon the nature of the work of the charity, the assets and the liabilities, and the urgency of any process. At this stage, the trustees should be taking advice and be guided by the insolvency practitioner as to the best process to use, so that the range of issues that are mentioned here are dealt with correctly and in the most effective manner. Now, there'll be a number of areas that will need to be considered when determining the most appropriate solution. However, the key point is that the earlier the signs of financial distress are identified, the greater amount of time, options and flexibility the organisation has to find an appropriate solution, even if an insolvency process is required. Next slide. So it's just important to recognise that where a charity believes it could be insolvent, insolvency legislation does apply, and trustees could have personal liability if found guilty of wrongful or fraudulent trading, and there is also a potential to be disqualified as a director. Now, as a reminder, wrongful trading occurs when trustees allow the charity to continue to trade when they ought to have known or really have known that there was no possibility that they would avoid that insolvency, and worsening the position of the creditors by continuing to trade on. Now, there's been some temporary easement of these provisions, which has been well publicised for the period between the 1st of March and the 30th of September. However, this does not detract from good governance here, and trustees should remain mindful of their duties. So hopefully, This session has reinforced the need for effective cash management and provided a greater awareness of some of the potential outcomes when an organisation is in financial distress, and how really to identify that distress and take the appropriate actions to mitigate the risk and losses for the charity. Next slide. So thank you at this point. I've set out my contact details here, and now I have pleasure in handing over to Deborah.
Thank you, Diana. I'm Deborah Burton from Shakespeare Martineau Solicitors. As Diana said at the outset, I'm a legal director in our contentious trusts and probate team, and we act for a large number of charities, both large and small and local, in connection with disputes relating to estates. So what I'm going to talk about this morning is legacies and the impact of COVID-19. I'll be addressing the importance of legacies to the charitable sector. We'll be looking at the immediate impact and what you may have been experiencing in the last few months, and things that you can be doing to mitigate that. And then I'll do my little bit of crystal ball gazing and try to make some predictions for the future as to charities and legacy income. Next slide, please. So just to highlight the importance of legacy income to charities, based upon SME and Ford, legacy income was worth nearly £3 billion to charities in 2019. That is a slight drop on 2018. But what it doesn't say on that slide is that £3 billion only comes from 4% of wills which make a charitable which leave a charitable gift. So as you can see there's a great deal of opportunity. In terms of investment, based upon Legacy Foresight's benchmarking study, they've looked at how much charities are investing into legacy fundraising, and have found that only 4% is allocated to that area, but yet it is producing 44% of fundraised income. So again, a real great mismatch there, but just highlighting how a small investment can make a massive difference. And finally as well, we've heard from a lot of our clients, as well as anecdotal evidence, that legacy income has really been helping charities weather this COVID-19 storm, whereas other income streams practically dried up overnight. For example, retail shops or individual monthly donations may have been halted, and those large fundraising events such as the marathon or those one-off events you're organising that had to stop. Legacy income was still coming through the door. And whereas that represents a lag from estates that may have been dealt with previously, it's obviously a fairly static source of income and is not necessarily affected by COVID-19. Next slide, please. Notwithstanding that, even though it's not impacted completely, there has been the impacts of COVID-19. So what we're expecting to see is a drop of legacy income this year of between 8 to 23%. But actually that is slightly less than what had been envisaged in March and April, where the outlook was a lot more bleaker. Now, if I've said that legacy income is fairly static, why has COVID-19 affected it? Well, there's administrative delays in simply getting those grants of probate. So at the probate registry, last year the probate registry was taken up to about 3 months longer to issue grants of probate due to the government's intention to introduce increased probate fees. So that led to a rush of applications, which in turn led to delays. The probate registry kind of caught up on that, but again, as a result of things like furloughed staff, they were affected by that and social distancing. So again, we're now back at about 2 months delay in grants being issued. Moving on to furloughed staff, so that effect is pretty much affected all areas, including the charities themselves. So yourself or maybe a legacy colleague has been placed on furlough, which means that there's nobody in the office to be, administrating these legacies, to be chasing up the payments, liaising with solicitors, etc. Similarly, solicitors firms, they've also had to furlough staff, so their administrative staff or even people in private client teams. So again, those grants of probate are not getting dealt with, and the estate's not being administered as promptly as you would wish. The property market, I'll come on to that in more detail, but as we know, that practically halted overnight. But it's really good to see that there's some green shoots now and the property market is starting to recover. And investments as well, as Ian explained earlier on in the talk, investment income has been hit pretty hard. So if an estate did comprise of investment or a share portfolio or even property, then of course that's then filtering through to the value of the legacies. Alternatively, executors may be sitting on the investments and not wishing to sell at this moment to see what's happening with the market. And so that then could delay the charity receiving their entitlement under the will. There's also been a drop in notifications. For those of you that are not aware, there is a company called Smee and Ford who basically obtain a copy of everyone's will in the country when it's admitted to probate, and they analyse the wills. And if a gift has been made to a charity, then those charities that have signed up for their notification service, they get informed as to the fact that they've been left that gift. And that's often the first time that a charity is aware of the legacy. Sometimes gifts are made to charities, or actually quite often made to charities where they may have had no contact or relationship at all with the charity. So in terms of notifications, we've heard that there's been a similar drop in notifications of between 8 to 23% for some charities, so mirroring legacy income. Next slide, please. So what can you be doing now? Well, getting cash in, as Diana says, cash is king. So if there is outstanding legacies, the key here has got to be chase, chase, chase. And I know that can be difficult for some charity legacy managers. They may feel like they're being overly aggressive, but actually now in this day and age, your charity is the business as much as anything else, and it's key that you get that income in. If solicitors or executors are dealing with reduced resources, unfortunately, it will be those that shout the loudest will get paid. But also, as well, as rather than simply sending an email, which can easily get lost in the pack, what we'd probably recommend is picking up the phone, even a nice call. There's less likely that your tone could be misinterpreted, but equally as well, you tend to find out a lot more over a phone call than simply a one-line email. And it also makes it a lot more difficult to ignore you. The next tip is to flush any claims out as sort of a put up or shut up. So it's quite easy for any sort of disappointed beneficiaries to seek to challenge the will, and they can lodge a caveat. Now, a caveat costs £20 and it lasts for 6 months. And when somebody lodges a caveat, they don't need to put any information really as to the grounds of challenging the will. So what effectively we have is these zombie estates which are going nowhere, but the claimant really has no intention to pursue anything. So again, a change of approach there of trying to push those claimants to basically set out their case, otherwise get that caveat removed and get that estate administered and the income through your door. Thirdly, interim distributions. We should really be seeking these for large estates, particularly if you're the residuary beneficiary. A lot of executors may be sat on large piles of cash. There may be no real reason why they haven't made an interim distribution. It may simply not have entered their mind to do so. They may have thought it'll be a lot easier just to deal with it all as one. But actually, if there's a real surplus there, you should be getting interim distributions, and it will really help with your cash flow. Fourthly, if there is any outstanding litigation, then you should be considering looking to settle that. Of course, you should take your own legal advice before doing that. But actually now, whereas claimants may have been more robust and willing to take it all the way to court, they will themselves be affected by the current coronavirus restrictions and possibly the risk of redundancy, etc. So they may be more amenable to settle matters. And similarly, just considering a change of approach generally. Now, one area which I've had great success in was acting for a client recently where a caveat had been lodged and had been in place for 18 months whilst we were waiting for medical records. And my suggestion, which I'm pleased to say was taken up, is that we agreed with the claimant, if they lifted the caveat and allowed the executor to get on and gather in the assets and sell the property, that the executors could give an undertaking not to distribute whilst we were dealing with the estate. So I'm pleased to say that that worked really well. And when we came to settlement, the fact that we could say that the claimant could have money within 7 days and thereafter our client could get paid out within 28 days was a real impetus to getting that matter resolved. And then it meant that our clients themselves could receive their income rather than then having to wait several months for either a grant to be obtained and then properties to be sold. Next slide, please. Property sales. As you may be aware, a property tends to be one of the main assets within a lot of estates, and so the current lockdown period really caused problems with that, because there was the whole thing came to a grinding halt. Were there any properties that were vacant in estates? There's absolutely no reason why those couldn't have been pushed through. And similarly now, it's good to see that not only estate agents offering individual viewings, but they've adapted well to any virtual viewings if there is people who are still a bit reluctant to attend in-house viewings. The stamp duty holiday, which has been great news, is effectively going to create a mini housing boom. It's going to release that pent-up demand, but that's only expected to last until March next year. So it's really key that executives get those properties within estates sold as soon as possible. So maybe need to look to reducing prices. Now, that doesn't mean that you have to wipe off 10 or 20%, but a couple of £1,000s here or there could really make a difference and get your property listed, higher on the Rightmove rankings and get that property shifted. One of our large charity clients now, they routinely adopt the view that they'll send their properties pretty much automatically to auction. Now, in the past, that's been viewed as very much a last resort, because people felt that you wouldn't get as much in auction. It's almost a distressed purchase, distressed sale. But that's not actually what's been happening. And even when our clients have had valuations from estate agent valuers, the auction prices have pretty much matched it. Also, as well, is auctions really useful for any of those properties that are a bit difficult or a bit quirky or need a lot of work. You do not want to be sat on that housing stock. The executives could be ending up spending a lot of estate money in maintaining that property, insurances, repairs, etc. So really, you've just got to get rid and get that legacy income over to you. So for properties that have any tenants and you may be having to seek possession proceedings, there is still a current stay on those until the 23rd of August. So next month we'll be expecting those to start moving, but unfortunately there will be a large backlog at the court. Notices to terminate certain residential tenancies, they're still stayed until the 30th of September, but it may be possible to start negotiating with tenants to see whether or not a deal can be done with them. Next slide, please. One area as well is that your legacy teams working in conjunction with the rest of your charity colleagues is highlighting and is the importance of stewardship. What we found with a lot of our charity clients is donors are more likely to leave legacies and wills if there's been a good relationship. And some of your donors may very well have been isolated, they may have been shielding, they may have found this really difficult. So actually a phone call from one of your team may be exactly that thing that they needed to receive, and then it strengthens the relationship between you. And again, whilst you're not going to telephone your donor, and the first point will be saying, have you made a will you leave as a legacy? Gradually building that relationship, you could maybe bring that around the conversation and an opportunity to maybe broach it with them. Some of our animal charity clients have said that they've had great success with forever loved type schemes. And what this is saying to their donors that if they've got an animal, they'll agree to take the animal upon their death, that they'll rehome it. And that's been very successful for them, again, in not only reinforcing the relationship with the donor, but as a result, there's often left a legacy in the will in order to look after the animal, or a gift to say thank you. And for those animal charities, they were probably going to rehome that animal anyway, because that is what they do. And so again, it just reinforces the relationship. And again, it's not just about getting legacy income now, it's about building the legacy stream for the future. Next slide, please. So the future of legacies. Well, the Law Society research said that there's been a 30% increase in will making during lockdown. Fair Will, which is a specialist online will making company, did a lot with the NHS and offering a lot of incentives for them to make a will, have reported a 300% increase. Now, on the basis that a charity will only get a legacy if they're in the will, then more wills for charities is good news. But equally as well, is not only for those people who have made wills, this current crisis has probably made people more receptive to doing so in the future. They realise that they probably have to get their affairs in order. So there's a real good opportunity here again to be providing for your income stream in the future. So do we think legacies will recover? Well, yes, it's good news. It's not all doom and gloom. Legacy Foresight have said they're still predicting an increase of legacy income of between 9 to 13% over the next 5 years. And it's predicted to double in real terms in 30 years. So at the beginning of my slides, I said that's worth 3 billion. So in 30 years, 6 billion. But again, if you remember, I said that only 4% of estates have a charitable gift. So even if now you invest and you only turn a few of your donors into leaving you gifts that otherwise wouldn't, 1 or 2% increase can make a massive difference. What we are finding and expecting is that there may be more legacies split between more charities. So rather than one charity taking the full residuary estate, a donor might be prepared to share out their wealth to a number of charities close to their heart. And what we're finding as well is local charities are tending to start to do better. So again, for any small charities out there, this is a real opportunity for you to look to really increase your legacy income. Slight fly in the ointment. I am a contentious probate lawyer. We are expecting a rise of increasing claims. Recessions do unfortunately encourage litigation with disappointed family members if they may be being made redundant or suffering financial hardship. They may view a charity, the money going to the charity is unfair and may seek to bring a claim. For those wills made in lockdown, we are expecting that there will be some very careful scrutiny of the wills to make sure that there was no suggestion of undue influence, that the party had capacity, and to make sure that the wills were witnessed properly. But of course, if you do face any such claims to a will that you are a beneficiary of, then of course, please take independent legal advice. We'll be more than happy to help. And the vast majority of these claims are sorted out fairly swiftly, or at least without ever seeing the door of a court. Next slide, please. Okay, so that was my talk, and like the rest of the panel, we'll now open it up to questions.
Thanks, Deborah. And I see that we've got a couple of questions just come through on the chat. So just going back to your presentation, there's a couple of questions that come through. Do you mind just clarifying what the total return approach is, please?
Of course, yeah. Thank you, Katie, for that question. The total return is simply where you discuss with your investment manager that you're looking for a set return. So, for example, you might sit down with the investment manager and say, long term, we expect this portfolio to deliver something like 6 or 7%. So you might decide, actually, I want to take out 3.5%, 3.5%, whatever it might be per year. But actually, I'm indifferent as to whether that comes to me via dividends interest or whether it comes to me via taking out part of the capital growth. So you can take both ways. And in that respect, you've got far more flexibility in what you invest in. You've got far more flexibility to continue taking your 3.5%, even if dividends are cut. There are additional rules about that, particularly if you're an endowed charity. The rules are not too imposing for those charities in England and Wales. Forgive me, I'm not absolutely familiar with the rules up in Scotland under Oscar, but I've certainly got colleagues who can help. But it is a way of perhaps getting greater security in terms of the amount that you're able to take out by adopting that approach, albeit it comes with an extra level of complication of complexity that perhaps isn't there if you just take the straight income that's delivered by your investments.
Thanks, Ian. Just a couple of questions that have come through. So, Michael Illingworth, you've just asked a question in terms of to address the risk of running out of general reserves while still having restricted or designated funds. What possibilities in terms of when, how might they be released? Well, I'd say here in terms of you'll need to look at the terms of those restricted funds and if they can actually be released. And the way to do that is by speaking to the funder and also the Charity Commission. Now, in terms of designated funds, these should be able to be released if they were unrestricted and put aside for a particular project which are discussed, and the board has now made a decision to not go ahead. And this is again why it's important to really have that flow of documentation, those regular meetings actually, documenting what decisions that you're having to make during this period. I mean, it's always going to be down to the specifics. So it may be something that you will need to just seek some additional kind of professional legal advice on. But hopefully that will give you a steer as to where you might go with that. I've also just picked up on the chat as well, just to mention about directors and officers insurance when I talked about mitigating risks in my presentation. Here really it's just looking at whether or not there are any particular circumstances that have changed within the charity, if there are any particular terms there that actually may trigger a liability or not actually be able to make a claim. And really what we're looking at here is responsibilities that you may have undertaken or not undertaken for projects in particular during the lockdown period. But Ian, if I can just go back to you and just really ask, is now really a good time to invest?
Well, I guess I'm probably biased, aren't I, being I guess the proper answer is, I mean, there's no straight answer that's right for every single charity, so it's always wise to take advice, to consider your individual circumstances. But broadly speaking, yes, I mean, markets have bounced back off their lows, but for us, they still look attractively valued. And I think one of the main points I was mentioning is that long term, investment income is a great way of diversifying a charity's other sources of income. It's one that's likely to be less correlated with the grants that you might receive, with contracts with other parties, with shop income, etc., etc. And it's a relatively secure level of income broadly going forward. So if you do have those form of reserves or endowments that you are able to invest, I think it's still a good way to do it, yes.
Margaret's just brought up a question in terms of, could you talk more about trustees' liabilities if an incorporated company becomes insolvent, and in particular what circumstances trustees might be disqualified for being a trustee or director. So the circumstances that we're talking out here is around that fraudulent and wrongful trading. So it's when we look at the concept of worsening the position of the creditors. So for example, if you already know that you are restricted on cash, and the business has, the organisation has the inability to pay all of its debts as they fall due, if you then take on a further burden of liability, because that essentially is then worsening the position of the creditors. And how this gets looked at is in the event that the incorporation does go into an administration or a liquidation. So it takes that look back at time. And really it's about here that perhaps you do need to make that payment, and it is essential for the ongoing trade of that charity. But this is where you do need to document it. So by documenting the reason that you took that decision, it's providing that visibility to that insolvency practitioner when they have to look back and have the benefit of hindsight as to what happened at that particular time. Fraudulent trading is clearly the one where there is a clear disqualification and even more serious in that respect. So that's actually doing something deliberate to the business. So this could be an act of misfeasance or otherwise, where actually there's assets being taken away from the creditors of the business for some other mechanism. It's a very technical area. It's very subjective, and I think it's to make sure that you have an awareness of those responsibilities and those provisions, and you protect yourself as much as you possibly can by just showing that thought process and really, involving others in your decision making as well. So, Margaret, I hope that gives you a bit of a steer. Michael's just got another question in terms of the impact on the US and world markets. And the mention of Joe Biden becoming the next US president. So
yes,
I think that might be yours again, Ian.
Indeed. Certainly, if you look at the polls, if you look at the betting markets, then Joe Biden is the clear favourite to become president in November, or certainly the November election. He won't come in until the new year. There is one school of thought that thinks actually that a Democratic president is usually associated with higher taxes, with more regulation, and therefore unwinds the Trump era tax cuts. That might be negative for markets, negative for the economy. I take a slightly softer view. I think we need to bear in mind the circumstances we find ourselves in that if this coronavirus COVID-19 crisis is still going on at that point in time, is he likely to be increasing taxes and trying to harm the economy at that stage? Perhaps not. It may be a potential negative in the future, but I kind of take it with a bit of a pinch of salt. And there are many areas, and I think many people would welcome a change of presidency in terms of investment markets and in terms of broadly anyway. So potential impact, but it's one of a number of things that we monitor at the moment.
Thanks, Ian. And I think, Deborah, this is just one for you that's come from Helen Whiteman. On legacies, will writing isn't regulated. If charities are hopeful of securing some legacies and they note the donor has not had a will drawn up by a lawyer, what approach should they take? There is a risk that a poorly drafted will not deliver the outcome desired, as per your comments.
Yes, thank you, Helen, for your question. And you are correct, will writing isn't regulated. But I will say, like with lawyers and like anything else, there's some very bad will writers out there, but equally there is some very good will writers out there who are indeed have chosen to be regulated by the Will Writing Association and also have insurance. But turning specifically to your question, if you become aware of a donor who has made a will in that way, and there is something that is setting alarm bells ringing you that this will may not be ideal, and if you feel comfortable in having the conversation, then you may suggest that will is maybe reviewed by a lawyer, especially if it was made during the lockdown period, because you can say, well, it was made in these particular circumstances. I mean, ultimately, if somebody wants a disappointed beneficiary wants to have a fight about the will, they will have a fight about the will. Ideally, solicitors, file notes, etc., will all go to help uphold that will, and will all go to help provide a lot of evidence and hopefully shutting a dispute down. But I mean, other than basically telling the client, your donor to go back and rewrite the will with somebody reputable, there's not a lot, in reality you can do. But it would be useful again if a donor is telling them that is telling you that they've left your particular charity legacy. I would make a note of that, because often one of the challenges that people say is that a legacy to a charity is just being made completely out of the blue, and that there's no connection to that. So if a claim does come in and you've got a history of dealing with this donor and that you knew all about it, then again, that supports the argument that this donor's wishes were quite clear that your charity were to benefit from their estate.
Thanks, Deborah. I'm conscious of time, so we will have to draw our Q&A to a close here. But if there are other questions that we've not managed to pick up in the chat right now, do feel free to get in touch with us, and we will endeavour to answer those queries as best we can, just as a follow-up to this webinar. Can I just take this opportunity to thank you for your time and attention today, and thank you to my co-presenters Ian Burrows and Deborah Burton. If I could make one request from an RSM perspective, please go onto the RSM website and complete your preferences so that we can make sure that we are sending you specific information relating to your business and sector. And if you have any questions that you want specifically answered relating to your own scenario, please do go to our COVID Inquiries Hub on the RSM UK website. And we've also put our contact details on our slides today. So I'll just finish really by thanking you everyone today, and please do take care. Goodbye.